So now what we're going to do is we're going to consider an introduction to Chapter 8. And basically Chapter 8 deals with accounts receivable. At this point in time of the course, we're really fine-tuning ourselves to specific accounts per chapter. We saw for the last two chapters, we pretty much dealt with one particular main asset account, which was inventory. Now we're going to move towards another important asset account called accounts receivable. And so basically we're going to finish talking about the ins and outs of accounting for accounts receivable. We already know what accounts receivable is. It's an asset, a short-term asset preferably, that arises or that is created anytime that you provide a service or sell a product, i.e. generate revenue, and no cash is involved, right? So you're selling a product on account or you're providing a service on account, either or, right? We know that accounts receivable is generated by a debit on the books. And so technically this whole chapter is about receivables in general, not just accounts receivable, but note receivables. And so I like to talk about the difference quickly between an account receivable and a note receivable. First of all, account receivables are short term. And they're very informal. You normally have a few days to pay it off. And it's pretty straightforward with an account receivable. Okay? Now, note receivables, on the other hand, are very formal. All note receivables are written. All note receivables are considered a contractual agreement. And most importantly, the majority of note receivables that you deal with will have some sort of interest involved. Okay? So account receivables don't really deal with interest, but note receivables deal with interest. One last difference with note receivables is that we understand that, naturally speaking, account receivables are short term. Your note receivables, in contrast, are always considered long term unless otherwise specified. And so those are the differences between account receivables, and we shall investigate how to account for them throughout this chapter. And so moving forward, we're going to spend half of the time, well, let's say the majority of the time, on account receivable. Then we're going to delve into the note receivable aspect of it. Okay? So let's talk about accounts receivable, and let's talk about where we're going with it. And so we talk about accounts receivable, but what's the real important reason? Why would a company want to sell something on account? What's the number one priority in regards to trying to sell stuff on an account? The correct answer is to generate more revenue, in hopes of generating more revenue, right? Because we know a couple of things happen when we sell on an account. When we sell on an account, we give a more opportunity to our customer base to purchase our products if they don't have the funds on them available. So some people who may want to purchase our products or receive our services, they may not at the time because they don't have cash, or they may not have cash willingly enough to expend on it. And so providing an account gives them the ability to get the service now or get the product now and pay later. Another opportunity is for existing customers. For example, I may want to go and purchase a pair of shoes today, right? But I only have, $800 to buy the shoes, okay? Well, how would that work if I was able to have a credit card at the time and I see another pair of shoes that I may like? Well, I possibly may buy more than just that one pair of shoes. And so it also establishes an opportunity for existing customers to buy more. So those are the upsides of accounts receivable. Now, once you've satisfied a service or sold a product, right, and created an account, your next priority should be to try to collect as soon as possible. And that would make logical business sense because what? You want your cash as soon as possible for two major reasons. One, you want your cash because you want to be able to buy more inventory. You want to be able to use that cash to satisfy certain expenses, your rent, your salaries. You need your cash. So that's why you want to collect on an account as soon as possible. And also that's why we offer discounts to people, which we saw how to handle in previous chapters. Okay? Now, another reason you want to collect on your account as soon as possible is because the longer that you wait to collect, the higher the probability you may not collect. And so that's what we're going to talk about in this chapter, how to account for uncollectabilities or uncollectibles. Okay? And so when we say uncollectibles, that's one of the major disadvantages of accounts receivable. You may not collect on your money. And so we need to know how to account for uncollectibles. And so that's what we're going to spend the majority of this chapter talking about pertaining to accounts receivable.